Why should someone deploy into something like Sypher Capital in a managed fund versus going directly into a protocol? Whoever wants to jump in first.
Sure, I'll start with that. Thank you, Jacob, for having us on. So, one of the things that's interesting about just Bitcoin in general is that there are many different types of holders out there. I think roughly about 1.5 to 2 million BTC is actually owned by Bitcoin whales. The vast majority is also a big chunk is also owned by the ETFs. And if you strip all that out, the MSTRs and of the world, you end up with roughly about 10 million Bitcoin out there. And about like 6 million of that is actually held between a K to about a K cost basis. Um, and in that chunk, there is a huge difference in terms of like who actually knows what they're doing. Our perspective when we started Cypher was effectively that there are a bunch of users out there who own Bitcoin and who are not that clear as to what's happening on chain. So their comfort level skews more to the novice side. It's very different than those who are actually using DeFi, who are very comfortable with the techniques, the systems, understand what Morpho is, understand what Lombard is, etc. But for our customers, and a lot of them are high net worth individuals. They have very demanding jobs. They work at hospitals as doctors. Like it is almost too much of a burden and chore for them to manage this themselves. And so for anyone who wants to abstract away the complexity of actually trying to generate yield themselves, we think we provide a service. Not the only service, but a service. One of the big advantages of actually working with a managed fund is that we are actively working to protect the cost basis. We have a team of accountants who are geared to tax optimize even your returns. And as a managed fund, we can do very nifty things. And so I think we are the only fund out there that could actually take our management fee and tax deduct that for the investor as well. Investors get a traditional K1 at the end of every year, and they get very full visibility and transparency to actually what we're doing, quarterly to yearly letters outlining what we do, and just a phone call away for most of our investors.
Michael, anything you want to add to that?
Yeah, I'll add something onto that. So, like, one analogy that we use when we speak to potential investors, new investors, existing investors is if your RIA came to you and said, "Hey, I think you need more credit exposure in your portfolio," you're not going to go to E-Trade or Ameritrade and say, "Okay, let me start evaluating these Microsoft corporate bonds or J&J corporate bonds and figure out how I allocate accordingly." You are either going to, put your capital into credit specific funds, maybe actively managed funds, because again, it's a tall task to go through all of these different filings, do all the diligence. And not only that, it's not a one-time event. You're constantly having to stay on top of it. And so, I think better than anybody else, this space is constantly changing. The yields that the strategies and the protocols are delivering are constantly changing. And so, like, if anything, like, I think it's just our experience doing this for the last year and a half has just reemphasized the fact that, like, you really need to take an actively managed approach to this.
Yeah, I want to piggyback on that because I think that's a really important point that Mike made. We're probably like, what, 2 years into just kind of where Bitcoin yield is generally. And in initial days, a big chunk of that was that spot versus futures trade. A lot of it was earning yield on a secondary stake token. And now we've seen that kind of move a little bit more to the side. And there are a lot of new things that are popping up. And so we're at that stage in the industry where people are throwing things against the wall. Some are bouncing off, some are sticking and will stick even harder. But the vast majority are basically sticking for a while and then peeling off slowly. And so we think, especially in this stage of the market, a managed approach is probably one that effectively serves better understanding how the dynamics of the industry changes.
Very well said. Yeah, go ahead.
I was going to say, and I'm trying to remember when we first spoke to you. I think we were probably readers of at least the Twitter account, I think day one. And we've kind of followed you guys closely ever since. Like, you've been in this space for a while. I know you've kind of ran pods built on Bitcoin, so you have a lot of experience on the space. Like, even the last year and a half, like, what are some of the changes that you've seen, just in that short amount of time?
Yeah. So there's two. One is strategy co-opting the term is very interesting to me. So like this digital credit and like, they tweet it almost every day of like BTC yield return on X. And it kind of goes into like how you define these things is actually pretty important. So I think that's one, is like the TradFi space is using the same terminology, but depending how you protect the asset or compound back into protocols and these kind of things, the returns can be different with the same wording. So that's one, is that the general space, I don't think they have, unless you're reading BitcoinYield, that you're in the space, you don't have that nuance. The second biggest one is that there's a much bigger focus now on transparency. I think I've been calling this year the year of the vault, and I still think that's the case. Like input through a smart contract, do a bunch of fancy things, and be able to like audit it down the line. But there's still pretty early days for transparency and be able to like go to a dashboard or get a report from a fund like you guys and be able to see all the things that happened. And the faster that feedback loop and the more you can get data into like how does the protocol manage the 1010 event or these different kind of things, I think there's still there's a big black box there. So those are the two big things that I'm seeing jump out.
Makes sense.
Yeah. You guys mentioned a bunch of good things in the opening answers. I want to go. So if you look at BitcoinYield.com, the number one yield fund or yield strategy we manage or track across the board right now is you guys. Last reported 4.9. You guys report that data monthly, kick it back to me, and I update. There's a bunch in that. In how you guys would get those returns. I want to touch on those in a second, but I want to take it back of like what was the original conception for why even launching Sypher Capital? Like what did you see in the market and like place us in kind of like going into late 2024, I believe, to actually do this?
Yeah. It's funny. We're at a lunch with a senior person at one of the Bitcoin L2s, and it was right when the genesis of BitcoinYield was coming out. And it occurred to us like what an awesome idea that was, because we own Bitcoin and of course we want to generate yield on top of it. Is there an easy way to do it? Is there a way that investors would like having that out there? And the more we talked about it with other investors, it became clear that it's a winning product, right? It is probably the most trusted asset in the crypto space. And it is now definitely traditional finance. It's on your Bloomberg ticker. It used to not be there 4 years ago, and now it is. And so that was kind of the start. And then Mike and I spent about a good 6 to 8 months thinking about how would we want to structure this if we were to actually have a product like this. And a lot of it came down to what do we want as Bitcoin holders who are not super DeFi savvy and coming in from the way a bunch of other folks are doing it. What would you want to do? What would you want to see? And so that was the start. It turned out like we met a lot of people who wanted kind of the same product, and iteration after iteration, we decided to launch. I think it was the beginning of 2025.
Yeah. No,
Anything?
the only thing I'll add on top of that is Steve and I are both Bitcoin owners, have a lot of friends, family that own Bitcoin. I think most of the folks that probably watch this podcast or that you speak to are crypto forward folks. But I'd say there's still a huge slug of folks who own Bitcoin that still don't even know what the term staking even means. And we know that for a fact because Steve and I had explained that to a couple people. And so I think that you have this like very large group of folks that own Bitcoin that would love the idea of generating yield on Bitcoin, but even something as simple as a vault and saying, hey, you just got to go to this website, connect your wallet, and basically submit your Bitcoin to this vault. Most people just look at you and say like, I don't want to touch that with a 10-foot pole. I'm just totally out of my comfort zone. And so that's also one of the value adds that we think we provide for those folks.
Very cool. Yeah, this is one. That's probably where I'm the weakest. I come from a very crypto native background. On chain is the future, and I'm definitely being dragged by my feet into like the value of the TradFi markets. Just how much capital is there, like you can't avoid it. But also, it's just like it's super mature. There's a lot we can learn from them. How do you guys view? And I'm not exactly sure the best way to answer or ask this, but like the on chain versus the off chain. Because at some level, even like the basis trade, which is where so much yield comes from because it could scale so well, is an off-chain behavior. So like, how do you think about that from like the fund structure, like getting yield, anything interesting there?
Yeah, that's a great question. And it's something that we spend a lot of time thinking about because the on-chain experience is the superior experience. It's the superior transparency experience. It is, from an operational perspective, easier to deploy. The problem is that it is unforgiving if you mess up. And so there is a path we see where we move more steadily and readily in that direction. In regards to kind of what's happening, the intersection of the two, not only from kind of the execution standpoint, but then also from the source of yield standpoint, right? That's the other intersection that's really fascinating. And as much as like traditional finance doesn't really understand the on-chain world, we find that like the on-chain folks do understand the traditional finance world better, but there are still some gaps. And moving into RWAs is actually something that's important to monitor because as we move into things like fixed income as opportunities for yield generation, it comes with a different set of questions and a different set of diligence. I'll give you for example, if you're looking at a corporate credit, what you're really doing is you're underwriting the credit quality and the going concern nature of a company. And if the yield that you're getting is in a subordinated debt, you need to understand the waterfall of liens, exactly what happens in a workout situation if things just don't work out or bankruptcy. And then what your recovery rates could look like. And those are things that like a fixed income credit analyst could do very easily. So as those opportunities persist more readily on chain, that traditional finance experience will become more necessary. And for the traditional finance investors, as they think about things going on chain, understanding the execution environment and how to provide kind of their white glove within the envelope of what happens on chain is also necessary.
Yep. I'll just add on top of that, like using Steve's example with RWAs. So, one of the really, really interesting tokenized products that have come out is basically different expressions of Stretch, STRC, from MicroStrategy. And when Steve and I first, came upon this opportunity and something that we're diligencing right now as we speak, one of the things that we said to each other was like, look, like, of course you got to evaluate the token and you got to evaluate the smart contract risk, bridging risk, all that stuff that we would normally do. But in addition, we looked at each other and said, okay, we have to build a micro strategy model now, like a business model to really understand that and to follow it and to track it. And I think that's one thing that we don't see, in the Twitterverse. People saying, "Hey, this is a really interesting product," which it is, but also understanding like, okay, now we have to get really really smart on MicroStrategy. Now we have to get really really smart on their financials, et cetera. And so that's one interesting nuance that I think the on-chain crypto forward folks will start gravitating to over time for sure.
Very good. I think one through line there is that the ability for the traditional market people to underwrite a deal is so much more mature. And part of that's because there's so much more data that goes into like being regulated and that kind of thing. So definitely more the Wild West on DeFi. So like when it comes to diligencing a protocol, what goes into that? And like you're mentioning one like these ones that touch Stretch and like you don't have to speak on, say, Saturn, for example, but just to give people some context, one of the tricky parts here is like we only do things that have BTC as the input asset. And so it's cool with a fund like yours where you can have an in-kind exchange that's tax advantaged. But with like Saturn, you have to come in with USDC. And so you're switching out of BTC unless you do some kind of like loan as like a second step. And it gets a little tricky. And that's just for context. But like, and so that I guess that's to highlight, like, you already have like a couple layers of diligence to look at, depending on if you're coming in with BTC or if you're going to swap out into USDC and then go into Saturn's version to get exposure. But when you guys think of diligence in a protocol, like, what does that kind of process look like? Something new comes in your radar. Maybe it has like a few million TVL, and you're like, okay, what's the process look like to go above board and maybe deploy into that?
Yeah, there's no one silver bullet recipe, and it can be that we optimize across a variety of different features, and it could be anything from like source of yield to the network quality to how robust the backing is, the financial runway of the protocol. It could also be operational security. We spend a lot of time just working with the team itself. And so we've spent anywhere from 1 month to over 1 year diligencing projects before getting involved. And a lot of it comes down to trust. And so when we look at the people that we want to deploy with, obviously honesty is really important, but we like to see joy in what they're doing. We love to see that they have a lot of curiosity in the space and they can be good partners. And so if we have a lot of that there in place, then the mechanics become a lot easier.
Yeah, and I think one thing that's interesting is I don't know if we've touched upon this yet, but Steve and I used to work together at a long short equity fund that was very focused on fundamentals. It was a bottoms up approach, and so you kind of had to know everything there is to know about whatever company that you were evaluating. And so a lot of the process, there's a lot of parallels there. So as Steve mentioned, we're meeting with those teams and we're coming up with diligence lists, and we'll go through those lists, and then we'll have more questions we'll call, and then we'll look at the security audits and go through those to make sure that checks out with what the management is saying. But like the point is a lot of the process that we take in approaching these protocols or yield opportunities is very similar to the process that we took at our former fund.
Very cool. It's interesting. One thing that jumps out to me, you mentioned like it's almost like a vibe. So you do a bunch of due diligence, but then there's a vibe of like passion, curiosity. Do I trust them? And this has always been a weird one for me because in the Bitcoin ethos, it's like, don't trust, verify. And what they really mean is like, I don't want to trust anybody ever if you go down to the extremes. But in the real world, like our gut is so tuned to a lot of these things that like trust gets you pretty far. So it is interesting that even when you're diligent in these things, it's like there's a framework and then I'm going with what feels right based on the many, many calls I've had.
I think that's right.
Yeah. I mean, like if you speak to someone, over the course of a year, right, and you're creating that relationship, I mean, one thing that Steve and I are doing we are kind of keeping a scorecard, right? If someone says in month one, hey, our plans are to do this, or this is one thing we will never do, like that is always kind of etched, not only maybe in the back of our minds, but maybe in our notes somewhere. And, we're always kind of checking that. And that's one part of building that trust. So, you know, I agree that there is some gut, but there's definitely, we definitely keep more of a scorecard there than that kind of defines, gut, if you will.
Got it. Okay, left turn question, but when I'm not working on BitcoinYield, I'm working with Bitflow, a DeFi protocol. And what I've seen on the inside is that there's a certain level of like existential angst when you're a DeFi protocol, because you always have this underlying question of like, wake up and your smart contracts got drained. Is there a similar kind of like what keeps you up at night thing when you're running a fund like yours?
Yeah, it's a different set of what keeps us up at night. From and Mike might have a different perspective. From my perspective, it's like, are we continuing to provide a good product? The market is changing so much that it could be that you need to cobble together many different pieces to make the solution. And then two is, can we continue to build the right relationships and partnerships in the ecosystem that we need to help drive forward the yield in the fund? So I think those are kind of the two big ones for me.
Yeah, I think when Steve and I created this, we kind of looked at each other and said, like, look, we want to build a product that is going to allow our, first and foremost, our LPs to be able to sleep at night. And if they are sleeping well at night, that probably means we're sleeping well at night as well. And so, like, from a security perspective, from a smart contract perspective, like, that is the reason why we do so much diligence on folks, because we want to position our folks selves and the fund and the allocations to be in a place where we feel good, we feel safe about where everything is. And so to Steve's point, like, I think if there's anything that keeps us up at night, it's exactly what he said.
Right. And just to give you another piece of context, we've had a lot of hacks in the ecosystem. And fortunately, and knock on wood, we weren't exposed to any of those. We did have a partner who had a little bit of a liquidity issue for a period of time in the last one, but it was easily manageable. And we think we made the right call on that allocation because the managers were just fantastic. They had talked about 6 months ago putting together a more robust framework in the event that there was such an event. And then we saw them start to execute into that over like 2-3 months. And then we finally made the decision to participate in the ecosystem and to see it all just play out in real time, and the protection that they had in the communication. We were like very, very pleasantly surprised and thankful that we had made that choice.
Yeah, I totally echo that. And one thing that's great about our decision to really create these relationships with folks and making sure we know the people behind each of the protocols and the yield strategies are events just like that. So for instance, when that happened, the morning of, Steve and I talked to each other. I think it was over the weekend, went through each of our positions, if you will, confirmed that, okay, we don't have any exposure here. But even having that luxury of like pinging like the founder of every single one of those strategies and saying, hey, we're pretty sure we don't have any exposure here, but could you just confirm that? And them saying, yes, you're right, there's no exposure. Like, that's unbelievable. That's just one of those things where, going back to having a managed fund versus doing it yourself in a vault, and maybe waiting 3 or 4 days for that protocol to maybe deciding to have a Twitter Spaces call about it. That peace of mind, I think, goes a long way. At least for our LPs, it does.
Very, very well said. I mean, when there's something like that going on and you're just staring at the front end, and that's your main contact point, it feels very lonely. I mean, you guys have run the fund for like a year and a half now. What's been some of the biggest lessons that you guys have picked up operating in the space?
There's no time for rest. Everything is just changing so quickly. And it's not just like where you get the yield from, because that is just an evolution in and of itself, but it's access point, right? What is the right access point to get to this? Is it inside of the custodian? Is it through your ledger? Is it through a Coinbase? Then there's also kind of, what is the value prop? Is it that they just want yield, or do they want a yield and something else? Or what is the right way to make it resonate for a more traditional investor? And so there's so many different things that are changing. Everyone is basically on their own, like on day one, when yield started, everybody was on their own little stone, their own little niche. And as things have evolved, everyone has started to move their second foot off into another stone. And there are a lot of overlapping places now. And so, the lesson here is that you got to always think about the customer and you got to always evolve.
What
And
is
just
you sorry,
go ahead.
real quick. You mentioned yield plus something else. What are some of those something else's?
Yeah. I think lending is a really good entry into that. Increasingly, as people have lower cost Bitcoin, it becomes a great opportunity set. And you could do it on chain, and we have a white paper on this. You could do it on chain at better rates than you can do off chain. And there is some type of middle ground we think that plays out over the next couple years. That's one. Two is just, what else can it do? I mean, it would be great to see the Babylon restaking thing take off. Like, can it actually be implemented? And then, like, we use it as collateral now for other things like mortgage, but it could be something even more interesting down the road. And so all these things will just evolve as Bitcoin evolves and as smarter people start to play around with different types of features.
Sorry, I cut you off,
Jacob,
Michael.
question to you. So just given everything that you've seen, all the different yield plays that are out there, and then, like we said before, all of your experience just covering the space beforehand, someone gives you a big check to start your own protocol. What are you going to start?
Good question. I'm not totally sure. I'll tell you what I wouldn't do. I wouldn't go fully on chain and like pick an ecosystem like Ethereum or, some layer two. So it had to be some level of abstracted away. And I'd probably lean into being regulated on the front, lean into some of that. So like we have so much more new clarity in the past year. And so I think being early, but also pushing the frontier of that is probably going to yield some good results. So yeah, I wouldn't get too dogmatic in the ideology of like pure on-chain only. That's one thing I wouldn't do, which gives me a lot of flexibility, I think, of where I could deploy. And it'd probably look like some kind of like on-chain managed fund like what you guys are doing, but with like a nice front end and an easy way to like bring in and abstract away all the kind of like taxes and stuff. The only other thing that I would really focus on, I kind of mentioned it earlier, is this transparency piece. I think there's so much opportunity to be able to just like click around a dashboard and know exactly where the money's flowing in, see the on-chain transactions across the board, maybe see their thinking of like, here's why we moved from this allocation to this allocation. Automated. One thing that's always weird to me is like on-chain and email, like never touch. Give me an alert that just says like, hey, my position's down by this, or here's, you just got your fresh deposit, here's you got $100 today or whatever it is. So I think connecting agent interfaces to pull MCP data, probably not manage positions, just report like, here's what's going on, is what I would focus on. So it would feel like a Web2 interface. It would take in BTC. It would look like a managed fund on the back end. That's what I would sprint towards if I had a good chunk of money right now.
So
Sounds like a
manage
solution.
regulated fund. I have to ask you, would that have been the same answer 2 years ago?
No way. No chance. No chance. And I probably wouldn't have even like touched, the bigger ecosystems like Ethereum back then. So I probably would have been like a very struggling product on like a Bitcoin L2 trying to make it work, if I'm being very honest. But yeah.
That's great.
Yeah, that's a good question. Let's see. Well, we went back and forth in the Telegram chat, and you had a question around the 5-point framework.
Yeah.
And you guys are helpful in helping me formulate even the current one, which I think is still it's early. It's really hard to in 3 simple colors like delineate so much information.
Yeah.
And so we try to make it like a green is hard to get, a red should delineate a lot of data, and then the middle is kind of where it's tough. So you guys have been helpful in that. But you had a question around this. I'd love for you to cue it up and we can kind of riff on it.
Yeah, no, absolutely. So like, when we went through the 5-point framework and, honestly, in our own personal opinion, we think we should be green or close to green in all of them, right? But, when you look through the definitions of each criteria that you guys provide, very transparent about, there's a few where it'd be impossible for us to get a green. So for instance, like custody, like it has to be, self-custodial, by definition, like that's just not going to happen at a managed fund. Although, we are, there are certain new technologies that are rising that maybe we can do that in the near future, but you get my point. And so I guess the question for you is like, we've always kind of said to each other, it feels like the 5-point system is kind of more for it's more crypto forward, which totally makes sense. And you guys been, again, transparent about it. But is there room for an additional 6th category? I would imagine you have, more and more TradFi eyeballs coming to the website as they do their diligence. Is there room for, institutional readiness type category?
Totally.
And so,
Totally.
sorry to put you on the spot, but I'm going to throw it on you.
It's a great question. And like, we're only going to be as useful as we can answer these questions for people that are deploying their capital. So like, it's necessary. I'm not sure. I do feel like it's probably worthy of an entire new framework, meaning like there's 2 tracks that they're just so different when it comes to being able to like, okay, can I exit on my own regard with my capital in an instant because I have the private key? Like that green is already pretty hard to tell from green, orange to red. So being able to put how well a fund like yours manages your custody because you're using MPC or BitGo, and like in the on-chain world, BitGo is a red flag. But in the traditional world and with their track record, BitGo is fantastic. And so how you reconcile those 2 is really difficult. So my gut says it's not a 6th category. It's an entirely different framework. And then we just somehow can label that on the website that like, this is this criteria. And when you look at the category of the fund of the thing, it's like, this is staking, this is a fund managed, whatever. So I think it would be that, and then getting in the weeds there, because I agree, like there's such a wide range of how a fund can operate, and you guys do very well in a lot of these categories, and some would be across the board. So yeah, basically I think there should be a whole new framework. I think as we go deeper in this category, it's probably going to happen. It's going to have to happen because that space is getting bigger and bigger, and there's so much capital there. The other thing I would say on the framework, and this is unprompted, but like the biggest gap for me currently is, I think category 3 is around yield sustainability. And like, there's so much in that topic that is again its own framework. Like, is it from token emissions? How sustainable is it? Can it scale with capital? Like, if you put 100 million in, is that going to go to 0, or can you actually get somewhat robust? Because like Lightning cannot sustain any kind of meaningful demand, even though the yield looks decent on our dashboard. So like, those were 2 things that in a perfect world, if I had infinite time and like a couple researchers, I would do both those things at the same time. I'd make the yield source much more in depth, and I'd have a separate category to be able to delineate things like Coinbase Institutional and Sypher Capital.
Very cool. Very cool.
Okay, what else? Well, I guess what are you guys excited about right now? Like, there's a ton of stuff going on with the vaults. Everyone's trying to figure out, a la Babylon, self-custodial staking, even though the yield is low on that. Other things that maybe I'm not aware of. Like, from what you guys have seen, what are you guys most hyped about right now in this space?
I can go. I mean, I'm sure Steve will add on to this, but I think a lot of it is what we've already kind of covered. But I think number one, you mentioned it, self-custodial Bitcoin. And there are options that are kind of emerging out there that we are heavily exploring right now. Number two, we've discussed this previously, but RWAs, again, it's an infinite universe out there of what can be tokenized and put on chain, especially for yield purposes. But I think what's more interesting for us outside of that is, how do you get some of those assets to work within like our framework, for instance, right? Because most of those assets, even with credit, the prices are constantly moving, right? And so how do you minimize that pricing risk? And what's interesting is real time. It seems like there are solutions, guys coming up with junior, senior tranches, et cetera, to come up with solutions for that. And so it's super interesting to see.
For me, I think a couple things. The first one is just the frenzy and the activity that can happen when banks get more materially involved in this space and wealth managers. Because if we think that there's a lot of overlap now between what the players are doing, it'll look very, very different when that market participant comes in. Two is just like the evolution of what Bitcoin can be over time. And if you just take the traditional finance lens of what has happened, like futures, derivatives, there are many more steps we have yet to go where Bitcoin can become kind of a pronounced financial asset. There are some projects now that are exploring those possibilities, and I think that's very exciting.
Okay, so we mentioned tokenization a couple times now. I don't know the space super well. I think Stretch is super interesting, and seeing it as like a pillar in a lot of these diversified portfolios is super cool. The question though is like with smart contracts, you know what you're getting into roughly. They're designed to operate along these lines unless there's a hack. So that's kind of the risk you're taking on. There's not much legal risk. It's definitely code risk. With tokenization, where are the edges there when it comes to risk? Like, I don't understand the legal side or who's custodying these things. So I have a blind spot here. I'm just curious, like, how do you guys think about those, or like how are you diligencing those things from that angle?
Yeah, so it is effectively an off-chain to on-chain translation. And that is where a lot of diligence probably needs to happen, is what are the mechanics for order entry and for transmission of yield? Who is actually doing it? How many people are touching it? What is their operational security around that? So that needs to be very tight when we talk about that tokenization process until there's such a time where you could actually mint a token directly from the source, right? Two, the ability to tokenize opens up a door to actually not just being beholden to that singular asset. You can split it up in many different ways. And we see Saturn already exploring some of this. And so you could create tranched versions of it, which is actually very, very exciting, right? Because there will be a different set of buyers for each one of those. And so that opens the door for a lot more opportunities. Third thing is like, if we talk RWA specifically and not like Stretch specifically, there is some type of weird arbitrage that happens in credit. A lot of times in the traditional method, like you're calling up brokers looking for paper and seeing if they have supply. So especially with the smaller ones, you have very wide bid asks on the credit, and tokenization effectively helps shrink that. But like who captures that delta? Really sure. So there seems to be there's that space. It's also really interesting to explore.
Or anything?
Yeah, no, I think just adding to what Steve said, we touched on this before, but I think crypto forward folks are going to have to put on their accounting hats. They're going to have to put on their financial analyst hats because again, a big piece of it is if someone says, "Hey, I have an asset, it's generating yield." Now you know that there should be a significant amount of data available on this asset that the originator, if you will, should be able to provide. So financials, capital stack waterfall, like Steve was saying. There's all these things, but again, it's one thing to just produce them. You have to go through them. You have to get comfortable with them. You have to get comfortable with the counterparty risk. And, I think one thing that the at least from what we've seen so far, is I think one thing that the TradFi guys putting these assets on chain will have to kind of figure out is how do you get the duration risk down? Because as you know, right, crypto forward folks want to be able to get out whenever they want to be able to get out. But most of these assets, let's say if you're talking about credit, a 6-month term is very, very low, right? And it may not even be worth someone putting that on chain if it's just a 6-month term or a 6 month is remaining. And so how do you come up with solutions around that to kind of keep the crypto forward folks happy? Where, for all intents and purposes, that is where all the activity is right now on chain.
Excellent, excellent answers. Okay, I want to start to bring this to a close. We've been going for 40 minutes. This has been fantastic. I want to ask about the conversations you have with people who you're trying to pitch them on deploying BTC and getting into yield products. Because on my side, it's already assumed that people want to deploy, so I'm doing the research kind of in the middle. And then on the far side, you have there's a lot of BTC holders that just want to hold into infinity and ride the CAGR. So when you're talking to these potential LPs, what's that kind of pitch like, and what's your pulse roughly on the appetite for yield right now versus still sitting and waiting on the pristine collateral?
Again, I think it depends on the actual person themselves. If they are a sub 5K whale, I think they're more inclined to just hold and or keep everything inside of a custodian and not want to mint a secondary asset. And so there is a market for that. There's a market for those who don't really care about protecting their tax basis. That's not for us. So the pitch really is for us, someone with 5 to 100 BTC, someone who is sitting on a relatively low cost basis and want to either diversify because they don't want to hold everything inside of one centralized party, and or think that it's a better way to just hold it, because if you generate income on it, bring up your, the downside risk becomes lower and your upside potential becomes higher. So that's primarily kind of who we're looking at and why they would want to be involved.
And one common thread throughout all those folks that we've spoken to, we mentioned this before, but we spent a lot of time kind of figuring out, doing research, talking to investors, and coming up with a product that we think has the best fit with those folks that we've spoken to. The one thread that goes through everything is, don't lose my Bitcoin. Please just don't lose my Bitcoin. And so that's why we've taken a security first mantra. That's why we've taken hey, we may not be, targeting double digit yields, but we can give you a really solid yield that we think is investment grade on chain. So, I think that's maybe the big difference from kind of the OG Bitcoiners and kind of the rest of the crypto world, which I'm sure, you are well aware of.
Yep. No, well said. That don't lose my Bitcoin is the one that it's the most important by far. And I think even with the current framework, I probably need to tweak that a little more to less, where's the yield coming from, and more about across the board, how is my downside being capped across the stack? Because everything else, earning 7% doesn't matter at all if you're one step away from, you know, losing the entire principal.
It's the sixth category, the sleep at night category.
Exactly. Last couple questions. What's a contrarian take that you guys feel strongly about in the yield space, or putting BTC to work?
So Steve might have something completely different, but my contrarian take, I guess, is in terms of how this space plays out, and maybe I'm just talking about managed funds, and maybe you can add vaults into that as well. But I think, we see some very, very, I guess, the big players in the space really kind of trying to put their foot down and capture the market. But I think the way this plays out, it's going to look a lot like traditional finance, whether people like it or not. And traditional finance is yes, we know about the Goldmans, the Morgan Stanleys, the Schwabs, et cetera, but it's actually a super fragmented space. There are thousands of RIAs out there, each doing billions of AUM. And I think the reality is people want a personal kind of managed touch. They want to be able to call their advisor on the phone and get an answer really quick as to what is going on with the market or what is going on with my portfolio. And I think that's kind of the way this is going to look. So I mentioned Charles Schwab, but we know them as kind of the big entity, but some listeners may not know that you have something called the Charles Schwab Network. and it allows it basically allows for this fragmentation of RIAs because they can hop on the network and they're basically served a very, very expansive large menu of all the funds and investment opportunities that are on the Schwab network. And I think me personally, I think that's the way it's going to go
Mm.
for Bitcoin Yield as well.
My contrarian take is that there are so many opportunities and so many new developments out there, but in the long haul, Occam's razor will win out. Simplicity will be valued over more complex scenarios or investments or situations that are very common today.
Okay. Uh, Anything I didn't touch on that we want to riff with the last 5 minutes or so?
I mean, I think we mentioned the very beginning, but we could talk about tax if someone's watching this podcast late at night and needs to sleep, but we think it's actually really interesting.
I'm going to fall asleep.
It's an important topic, unsexy and very important.
Yes, yes. I mean, I guess I'll just throw a bunch of like kind of quick one-liners is, we've had the luxury of creating, as we said, relationships with some pretty big protocols in the space. And as some of those large protocols start to get ready for TradFi, a lot of them are now just starting to think about tax. So for
Mm.
instance, you tell someone to go into your vault, that TradFi person is going to say, well, what are the tax implications? Are they going to get a K1 or like, how do we know what's happened? Like, what is trigger tax in that vault? And I think the reality is people hadn't really thought about that before. And so, if you're going to cater to this large or try to get this very, very large TradFi nugget, and when I say TradFi, I'm talking about not the large crypto brokers, if you will, like Coinbase or BitGo. I'm talking about the true traditional finance folks that are just kind of dipping their toes into Bitcoin as we speak. If you want to get those folks, like you're going to have a very, very strong framework on tax. You're going to have a very strong framework on reporting, et cetera.
Yeah, this is a really. You're making me think too. We were chatting in back channels around KYC, KYB, and these kind of like regulated entities. And I think this space, especially in like the being compliant up and down the stack, like 2 years ago, it was just like send it, make it technically possible, something that wasn't previously able to do, and like disintermediate all the things. And as we mature, I think it's much more about interfacing into the TradFi system and the fiat system deeper and deeper so that they blend. And we're already seeing this with like the Web2 companies bringing crypto on chain. But yeah, any thoughts on this since we chatted around KYC, KYB, these kind of things? Because it's definitely heretical depending what kind of Bitcoin you're talking to, but it does seem like it's where the market's going.
Yeah. My take is that the vast majority of regular users don't care because they go through it anyways on a daily basis. The Bitcoin native, hardcore Bitcoin believers, obviously, we all have more of a philosophical bent to it. And I think for the doctor that has like 15 BTC, it's not a big deal.
We've had one or two cases with us onboarding an LP, and a form wasn't filled out right, and we have to then go back to them and say, hey, you have to fill this out again, and we need this information which you didn't provide. In most cases, you think, oh, you hope you don't annoy them, as you're onboarding them. But I think in all the cases, when we say, hey, sorry, I know this has been a hassle, but we just need the information, all of them respond the same way, which is like, yes, it's a little bit of more work on my end, but happy to do it. If anything, it makes me feel a little bit better about going into the fund to know that you guys have all these guardrails in place.
Yep, makes sense. Okay, last question. What is some places that you guys stay up to date on these things? Like, obviously, you can read Bitcoin Yield, as you should, subscribe to the newsletter.
Yep.
But besides that, like, are there any good places, or like, do you just have to like do the work of like reading protocol websites? Like, what are you guys paying attention to?
I think
Let's see.
I was just going to say what I found the most valuable is just talking to people in the ecosystem and making it a point to give someone a call every now and then just to catch up. And the other interesting angle to take is to just talk to customers about what they're being pitched.
Hmm.
And, it's wild because if you talk to a whale, they get pitched all the time. And so they have a lot of insight as to kind of what is going on in the ecosystem and what they like and what they don't.
Right. Totally. And this is basically to say that the only source on Bitcoin Yield is BitcoinYield.com and the associated newsletter and the associated Twitter account. But in all seriousness, I mean, there isn't really a space to get information on these products, outside of, protocol's own docs, their white papers, et cetera. And we think you guys are doing a great service to the community, which is why we've been super interested in following you guys since the very beginning.
Love it, love it. And I appreciate you guys reaching out early. You guys have been a fantastic touch point and helping me wade through all the messiness and understanding even the pain points. So much appreciated. Man, this has been a fantastic conversation. Thank you guys.
Thank
I'll
you.
leave links. I'll give links to everything to find out more about you guys, and I'll report on you guys down below. But until next time, gentlemen.
By the way, I'm still salty that you guys got the BitcoinYield.com domain space. As soon as I saw it pop up, as soon as I saw the Twitter account, I went to the site. I was like, dang it, why didn't we get that domain?
That would have been iconic to have that point to just a specific fund. It goes to Sypher Capital.
Hey, spoils go the victors go to spoils, right?
Love it, love it. All right, thanks,
Thank you,
guys.
Jacob. Have a
All
good
right,
one.
thanks a lot, Jake. Appreciate
Bye-bye.
it.